Ending December, what are we? December 12th, 2025. We're going live on YouTube here for the first time. So we're certainly going to uh, check that out and keep an eye on that. We'll see how people tune in and feel free to ask any questions. This week it was a very interesting week in markets. Certainly, some trends that were starting to emerge in some of the harder assets, metals and mining. Kind of continued for the most part this week, and really it was a rotation out of growth and into value. And I'll show you that chart here in a little bit. But the AI trade in general, and you had earnings from the likes of Broadcom and Oracle. Those are kind of the two big ones where the market didn't react very kindly, and so uh, that started to weigh on everything AI related. And we had the Fed meeting, and the Fed announcement was as expected when it came to policy, which was cutting rates by a quarter percent. But really, was the real story and the underappreciated story was QE is back, and I'll talk about the balance sheet of the Fed and why that's important. And there was a little interesting trend with bank earnings or not, sorry, bank lending, which I'll talk about here in a little bit. So I'll share my screen and go through this, and feel free to ask any questions as we go along. Let me pull this up here. All right. So let me pull up this data, and I'll start off with the heat map here. And this is the 1 day. Let's go to the weekly. Okay, so this is the 1 week from for the broad S&P. You can see the different sectors here, and what you can see, there's a lot of red, a lot of green, but a lot of red as well. And where was the red concentrated in those Mag 7 names? If you look at it, what only Tesla eked out a gain for the week. Google, Apple, Nvidia, Nvidia down nearly 5% on the day. Microsoft down a little bit. Sorry, on the week. Amazon down nearly 2%. Oracle down 13% on the week. Broadcom 6%. Tesla was the only one eking out about a 1.3% gain here. And on the finance side, you had strength there. Goldman Sachs, Mastercard, J.P. Morgan, even some of the private equity names like KKR hung in there. And you had some weakness out of health technology, excuse me. And but elsewhere, a lot of decent moves. Exxon up nearly 2% on the week. Philip Morris, Pepsi up over 3%. So certainly a mixed bag overall. Now, if you look at the sectors, we'll dig into. This is a good chart, so you can kind of see on the right side what the performance of the different sectors are. So for the week, you had 5 sectors that were down, and the worst one was clearly communication services. So that goes back to your Googles and your Metas of the world, right? 3 and 3. They were kind of the leaders to the downside there. Not a shock why the sector was down about 3% on the week. Now, what else is down? You had information technology down 2.3%. So tech was also down. Utilities continue to be under pressure. I think part of this is higher interest rates, as well as they're part of the AI trade now, right? Because if these data centers aren't being built as fast, then that's going to reduce the demand for electricity, or at least the demand expectations for electricity, which continue to be very strong, even though they've come back a little bit, it looks like. What else? Real estate was down, another kind of bond proxy area. And then energy. Energy had a down day, or down week, excuse me. But that's been strong of late, which I'll zoom in out to a monthly here in a second. What was up this week? Consumer discretionary. You had, where are we? Healthcare. You had consumer staples, and the top 3 sectors were industrials about 1.38%, and then both financials and materials up over 2% on the week. And this goes back to what I've said for a long time, which is there are certain sectors that do well in an inflationary environment. And when the Fed starts doing QE and starts to expect some sort of stimulus, monetary stimulus that's going to cause inflation, the market reacts, and the market reacted accordingly this week. Here's a monthly chart. If we zoom out, now you still have communication services as the leader over the last month, but you can see how far it's fallen, and it's coming back down to the pack. The worst sector continues to be utilities because of those higher bond yields. But now information technology, now the second worst sector over the last month. Everything else is kind of middling, it kind of in that 1-2% range. So here are the outliers in both directions over the last month. So it's a good overview of what's going on with the sectors. Now let's dig into some of the data. Not a lot of economic data this week. There was some jobs data around initial jobless claims and continuing claims, but they're kind of all over the place. So it seems like the government shutdown kind of messed that all up. So we're going to wait until that kind of stabilizes. Otherwise, it's kind of pointless to look at because you had initial jobless claims fall dramatically last week, but then rise dramatically this week. And it's just, once again, it's just all over the place. So kind of pointless. I wanted to get on this, which I talked a little bit earlier, which is the bank credit. I talk about how important it is for bank credit to continue to rise. Now, what's interesting here is that the the commercial banks have been lending to private equity and to that space, kind of post financial crisis. This is where they're taking this. They're allowing the private equity firms really to be taking a lot of the risk that they used to take. Okay, a lot of the lending in our economy, especially on the corporate side, has moved into the shadows of private equity and private debt. So this is a very important data point to watch, and I've said that for a while. And what's interesting here is the last couple weeks had a little tick down. So we're still over 5%, nothing alarming yet, still in an uptrend, but a little wiggle here. So something to continue to watch. And then you have the this is reserve balances at the Treasury. So Treasury General Account. It's basically what this is. And we talked about before that 850 billion is their target by year end. And guess what? We're at that. So this is not going to be a tailwind to markets between now and year end. This is basically where their goal is by the end of the year. And so talked before about when this rises, that's draining liquidity from the economy, and when this falls, it's adding liquidity. And it's fallen over the past week, but it's at that target. So I don't expect that to have an impact one way or the other between now and year end. And then this is the reserve balances. So this is why the Fed started to do QE. So if we zoom out here to a 10-year chart, what you can see here is this explosion of the reserve balances kind of post COVID, and there was way too many, over 4 trillion in reserve balances, and that was just way too liquid for the economy, and that's what you saw, that inflation, M2 growth, all of that. And the Fed is trying to moderate that, but it looks like their numbers are right around that 2.8 2.8 billion, excuse me. Yeah. So 280 billion. There we go. No, 2.8 trillion. Sorry. You have all these numbers here. But what you can see is the last time it got this low was during the regional bank crisis. And so, it's not shocking to see them go back to QE in the midst of those low reserve balances. So expect that. Expect this going forward is them to maintain these reserve balances because they don't want another regional bank crisis. And then if we look at the if we look at the next Fed meeting and beyond. So we had the Fed meeting last week, like I said, as expected, outside of the QE. QE is now started. I believe they started yesterday. Maybe it's a Monday. If I know it's coming soon, but um, that's going to be more important. This is more important than this. Everyone's going to focus on the amount of the Fed funds rate and where interest rates are, but the amount of reserve balances and the amount of bank credit, that's going to be far more important to the broader economy. Because without this, if they have not enough of doesn't this doesn't happen, right? If they don't have enough reserves to lend out into the system, then that's going to cause a deflationary situation, which powers that be, they don't want that. They want some level of inflation. And it's pretty clear they're comfortable with 3% inflation versus 2%, which is what they talked about before. Let's see. Pablo is saying Fed is calling it something else, not QE. Yeah, you're right. They are calling it something else, and they did this before, right? It's going to be an alphabet soup of some sort of new thing, but you have to understand what their goals are. And you can sit there and criticize it, but it doesn't matter. It doesn't matter what you think. It doesn't matter what I think. It matters what is. And this is the way the world is today. And you have to adjust your thinking, adjust your portfolios accordingly. Okay. So, yes, the Federal Reserve is growing their balance sheet once again. And while they probably aren't going to cut rates next meeting, remember, Jerome Powell only has 3 meetings left, and the base case here is that they will do one more rate cut, basically between now and the April meeting. Okay, and then it's up to the new Fed chair. So a little bit more decline in interest rates. We'll see where that goes. Now, the canary in the coal mine, as I've always said, is of liquidity is Bitcoin, and Bitcoin continues to be in a downtrend. So we broke down below. The support was right around that 106 level, 105, and we broke that back in early November. We've been in a downtrend ever since. We had this little bounce over the past week or so, but this is a pretty meager balance. We have to get back above 100,000 for you even to talk about this downtrend being over. And until it is, the path of least resistance is lower. And this to me is telling you that the next move is lower when it comes to the Bitcoin price. And most likely the markets. Now, is it a is it a move lower that's going to uh, that you should have your hair on fire about? No. This is most likely a move lower to be bought, to be honest with you, because of the steepness of the yield curve. The yield curve is rising, which means that banks are going to be incentivized to lend. When you lower the Fed funds rate, you lower rates on the short end, and the rates on the longer end go up. That is when you get incentivized, or banks are incentivized to lend out to the economy, and that is generally good for asset prices and economic activity. So, while near term, I think the if you go look at two companies this week, you look at Broadcom. Let's see if this wants to pull up. Doesn't want to. Okay, let's go to Oracle then. See if that wants to come up. Yeah, maybe it's because I'm going live and my charts are a little slow right now. Let's go back to the S&P. There we go. That wants to pull up. Let's go to the Qs. See if the Qs want to pull up. I'll just pull those up. Yeah, Qs are certainly rolling over here, not even getting back to that new high or that high that we saw in late October, early November. If you go and look at the growth to value trade, this is rolling over. So growth was outperforming all about the AI trade, and now this is clearly in a downtrend. You're losing the zero line on the MACD. This looks to me like the start of a broad correction, really driven by those AI names, because here's Broadcom earnings, obviously still in an uptrend, but pretty bad reaction on that front. Same with Oracle. Obviously, this has been a downtrend since that announcement with OpenAI, and it's clear that the market doesn't love the amount of money that they're spending on data centers to really service OpenAI, who may or may not have the money to pay Oracle. And I think that's the worry here, is that it's kind of a de facto bet on whether OpenAI can continue to finance themselves. Pablo says, "Are you expecting a recession?" I'm not expecting a recession in the short term. Could we get one next year in the latter half of the year? Possibly. I think a lot has to do with private equity. We had the issues with Tricolor. We had the issues with what was the other one? Trying to remember the other big recent bankruptcy in the space back in September October timeframe. First Brands, there we go. If you have more of those and you start to see the banks pull back from lending within the space, then I think you could trigger a broader recession. But until you see, and I'll show you this, here is the eights. There we go, SHY. So this is short-term junk to short-term treasuries. So what this means is when it's going up, that means that short-term junk is hanging in there. It's the credit spreads aren't widening out. This was This drop was back in Liberation Day, and you can see how quickly it rebounded and it's been hanging around this level. Now we are in a bit of a downtrend, but it hasn't broken down yet. So this can kind of hang out here for a long period of time, and that means credit markets are doing just fine. And so as long as that's the case, the path of least resistance for the economy continues to be okay. The labor market is still not great. Now, how much of that is AI driven? How much of that is tariff driven? I think it's probably more AI driven than tariff driven. I think tariffs are having an impact finally because companies are having to reorder. The effective tariff rate's about 10%, up from about 2% at the start of the year, and it's effectively a tax. It's a tax on corporations, it's a tax on citizens, and they're passing that on to the consumer in some way. And so it is a drain on liquidity. This is money that's going from private corporations, private individuals into the coffers of the government. Okay, so it is the opposite of government spending, it is a tax. And so, as long as that is the case, that is going to be a bit of a headwind to the broader economy. However, you still have the tailwind of lending. Like I said, if you have the yield curve steep, it's going to incentivize these banks to lend, and that is going to make it hard for a recession to happen. So, am I expecting a recession? I'd say yes, but what time frame are you talking about? Is really the main question. Over the next 6 months, no. You get back in the back half of the year, I think there's that possibility, but we'll see how the first half of the year evolves. Do we have another Day type of event? Do we have some sort of geopolitical problem that's going on with Venezuela? Is there something that happens, over in China? What happens with Russia and Ukraine? All of that is, a curveball that could certainly come into focus and cause upsets in markets. What I am expecting, what I will say, is a pullback in markets that refreshes sentiment. Okay, that refreshes sentiment, and I think there will be buying opportunities there. Now, I do want to highlight this. This is EFA to IWV. So this is foreign stocks to the domestic markets. And obviously, the domestic markets are heavily weighted on those Mag 7 names. And what you see, let's zoom out to a weekly chart here, is this really exploded beginning of the year and has been consolidating ever since and looks to be trying to head a bit higher in the short term. And the big question is that where, the market's going to continue to rotate, especially with the dollar. And the dollar is really the story here. This is peaked. I don't think this is a coincidence that this peaked when NASDAQ peaked roughly, right? And the Mag 7 names, many of them have peaked. Look at NVIDIA. See if it wants to pull up. There we go. Right. NVIDIA peaked. This is in a downtrend. This is not looking good. This is one of the poorest short-term charts I'm seeing within the tech space. So obviously, what's happening with Google and their TPUs and their new models with Gemini 3. That's for a lot of people really like it. I know I'm starting to use it a bit more than ChatGPT Pro, and so NVIDIA is very tied to that ecosystem. And so if the demand for their chips wanes in any way, I think this could go down pretty dramatically. And another tell here is they just got approval for selling their chips to China. Now, what I will say is they were already doing it. They were just doing back channels through, I think, Taiwan or Singapore, Vietnam. I think maybe some one of those countries were kind of smuggling them in anyway. But clearly, that didn't give any juice to the name, right? When a company has good news and there's not a good positive market reaction, that's a tell. That's a tell that kind of all the money's in, and the downtrend is started. And so obviously, Nvidia is still the largest weighting in all these major indices, and if this falters, I think the broader indices could have a pullback as well. Now, I'll talk about this. So this is the S&P, right? So kind of similar, doing a bit better than the Nasdaq because it's not quite as weighted to big tech, but it's certainly losing momentum. And would not shock me to see this return to about the 200-day moving average over the next few months, and get a sentiment refresh. And I think that's what is needed here. Kind of people got over invested in AI, and you know what's going to happen in the new year. I think there's a certain amount of investors that don't want to take their profits. They have big profits in these names, but they're starting to see the momentum wane. And I could see this new momentum into harder assets and away from the bits in the sky and the AI names accelerate into once we hit the new year. Let's get to a question here. Uh, oh, Paulo says Black Swan. No, this is something we addressed, which you're going to see our holiday special coming up. Is everyone wants to think the sky is falling? No, the sky is not falling. What's happening here is it's a new environment. People aren't used to it. People aren't used to an inflationary environment. That's the problem. Okay, that's what we're in. We're in an inflationary environment. That's not I mean, it's just it's different. We saw this if you go back and look at history. This is the 1940s and 50s. Similar debt situation. We spent a bunch of money, national highway system, et cetera. We try to grow our way out of the debt, and we were able to do that. Now, you're able to do that by doing yield curve control. And what the Fed is doing with QE or whatever they want to call it, expanding their balance sheet is something very similar. And they're going to cut rates, right? That's good. And the release valve is going to be the dollar. So it's just an environment where de-dollarization is slowly happening. And as I said before, it's not a coincidence that the markets kind of peaked and the dollar was in a started to decline. And this is kind of that yen carry trade unwind that remember we had last year with the yen that was here, this big explosion. Excuse me. Zoom out here. There we go. This last summer, this was the yen carry trade unwind. And, do we get another rally in the yen and the euro, right? The euro. Let's get the FXE. Euro is another carry trade. They're talking about maybe raising rates while we're cutting rates. The Swiss franc as well. This is also getting some traction and very strong. And so the dollar against a lot of major currencies continues to be very, very weak. And so I think this could be the catalyst for foreign investors flowing out of the major indices, Mag 7, because they don't want to take the currency risk anymore because of what the Fed is doing and that aggressive policy. I do want to get to a question. Gene's talking about URA, uranium. Yeah. So this is what I think is getting is it's kind of AI light in a way. Now this has been in a downtrend since late October, and I probably wouldn't be buying it quite yet. I think that this will set up a good buying opportunity. However, we own some uranium names, something adjacent. They're stronger than the URA, so I still recommend individual names because there's a lot of crap inside the URA. So if you don't want to do the work, sure, you will use URA, but I rather buy some individual names that are stronger. And you can go take a look at which ones those are because there are plenty of them. And obviously, URA holdings are public. But ultimately, this will take a hit and have this broader pullback. And maybe this is the tell, right? The fact that this has already topped recently, that the AI investors are moving out of the AI trade, at least in the short term. Now, I think once again, this will set up a buying opportunity in some of the industrial names that service AI, as well as AI energy plays, all of that. But I think that we're at least a few weeks away, maybe a couple, 2, 3 months away from that real good buying opportunity. What you want to wait for is sentiment to get really bad, right? Oh, the AI trade's over, and AI was this big hype thing, and nobody wants it anymore. That'll be when you want to buy it. Okay. Paula says, at my age, I like tips. What are your thoughts on these treasuries? Yeah, tips. Tips are fine. This would be the conservative way to gain. Oh, sorry, TIP. Right there we go. Yeah. So this would be the conservative way to hedge against inflation. Now, the aggressive way to hedge against inflation is gold, right? Gold continues to be strong. And while I still am not convinced this is going to break out to, firmly to new highs in the short term, mainly because if we get a market pullback, kind of everything gets sold. Gold tends to still get sold as well. But this is the better hedge against inflation. But if you want to be conservative, tips are the conservative hedge against inflation. Okay. So let's talk about, since we're on this topic, like I said, I don't think we're going to get a major breakout, but more of a consolidation period, kind of similar to what we saw back in April, May. Still modest pullbacks. Try to made a new high here in June, and then just kind of consolidated before that real breakout in August. So do you get something like that where this more consolidates as we get to a broader market correction? I think that's certainly possible. And then it's still a good buying opportunity because I do see by the end of next year, 5,000, maybe 6,000 gold price. Silver also doing very well. That once again, sentiment got a little extreme recently. Not a shock to see that pretty decent pullback on good volume yesterday. And so, and that is a short-term bearish sign. It engulfed the previous day on above average volume. So this could be also a signal that not only are the precious metals going to pull back a bit, but once again, the broader market could pull back a bit. Let's get into some of the other kind of sector ETFs. You can see this is the Mag 7. So once again, this peaked back in October and is now in a bit of a downtrend. Let's take a look. Oh yeah, semiconductors. Obviously, this is very similar to the Mag 7. Big down day on volume on Friday. Obviously, Broadcom was a big part of that. But Intel was kind of holding it up as of late. And that's getting a bit of weakness as well, even though this is in a broader uptrend. We're long Intel, so we still like it, but Nvidia certainly is the bellwether here, and Broadcom's probably number two. If you go to this heat map, let's go to there we go. If we go to this heat map and you're looking at the semiconductor names, obviously Nvidia is number one, and then Broadcom. The size of these boxes are the size of the company, the market cap of the company. Right? So the bigger the box, the bigger the market cap. And obviously, Broadcom and NVIDIA, much bigger than any of these other semiconductor names. Look at the size of AMD, Intel, Qualcomm. These are a much smaller names. So as the NVIDIA and Broadcom go, as does the semiconductor ETF for that sector as a whole. Let's see, what else do I want to get to? Private equity. So private equity has gotten a bit of a bounce as of late, but this is still in that broader downtrend. And this is, I think, still the biggest risk in markets is how does this manifest itself into next year? And are there more cockroaches, right? Tricolor and First Brands were the first big cockroaches, and odds are good there's more out there, right? And so how many of them come to light next year, and does that start to spread fear in the banks so that they pull back their lending into this space? And that is the biggest risk. This is where the subprime bad lending happened in the economy over the last dozen years or so, is in private equity, is in private debt. It's clear, it's obvious. It's just a matter of how bad is it, how leveraged is the system. They did the CLO thing, right? So a lot of people are buying things like AAA. This is the AAA tranche of the CLO market, and you would think it's safe, but as we've seen with the CDOs back in the financial crisis, it isn't necessarily safe. You look at, there's also the J triple B. I always love that one. Sorry, J. I messed up my watch list over here. It's another one of those private equity names. You can see this has been relatively weak. So this is the triple B tranche of a lot of these CLOs. And so this is where the risk lies, and we'll continue to watch. If this becomes dislocated, right, you can see the downward volatility back during Liberation Day. And so this is actually what you want to watch. If you look at, the HYG or the junk bond market, it's not really going to signal much because that's not where the bad lending happened. It was really in the CLO market, private debt, private credit, etc. All right. I think I might wrap it up here. Oh, here's one last one. I've talked about this. This is one of my recent favorites. So this is small caps, but it's the Russell 2000 and the S&P 600, two different indexes, both small caps, but the S&P 600 is choosier. They have better names, a lot less companies that lose money. And if this is outperforming, money is flowing into safer names out of the riskier names. And this is in an uptrend really since October. And that means money is moving into safer investments and out of the more aggressive names. So as long as this heads higher, it means that it's going to have the market's going to have a difficult time making new highs, and you start to see the path of least resistance being lower. And that's what I expect over the shorter term. Once again, it's not a black swan event. It's not hell in a handbasket. It's a market rotation. It's a sentiment refresh that is badly needed after a very strong move since the April lows. Uh, all I think that's about it. If anyone has any last questions, don't hesitate to put those in. I've been on for about a half hour. We're going to try to do these a little more often. Just some live chats, very different than what we do with the podcast. A lot of those are recorded questions, but this would be great for people to pop in, ask their question, and move on and get it right away, as opposed to leave a question, you might get it a little bit later. We love the live calls on the show, but hopefully this will be a good resource for you as well. So appreciate you all tuning in, liking, and subscribing to this channel. And for everyone out there, this is meant for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Hope everyone has a wonderful